Hey, Nick Kellar, Atlas Premier Realty, coming to you with another video blog. Today, obviously, I'm riding solo. Feel a little bit like a news anchor sitting here by myself. But I'm going to do a market update for you guys because we haven't done one in a while, and we're towards the end of the year, and I just want you guys to know where we are with the real estate industry and what's gone on over the last few months and what we're seeing going forward into next year, it's 2019. So I like to outline this in a couple different ways. So we start with lead indicators because they kind of are predictive as to what might happen, followed by lag indicators. What we are kind of seeing and feeling just being in the trenches every day. And then, what you guys can expect and what's next. So I'll start with the lead indicators. In our industry, these are things like new listing contracts, so new homes coming on the market, and new contracts for buyers purchasing properties. And I always look quarter over quarter because it's a nice sample size versus month over month. And what we've seen this year for new listings, so new homes coming on the market, inventory, is things have actually been down quarter over quarter, anywhere between 7 to 12% in the Baltimore and Carroll County area. So what does that mean is we were having less inventory than we're used to seeing from year to year. New contracts, so these are buyers that are putting homes on or putting contracts in on homes. We've actually seen that flat quarter over quarter since 2017. And so when you have shrinking inventory, followed by demand that's remained pretty flat, you can see that there's a relationship, an inverse relationship between supply and demand, which has put pressure on prices. And you've probably seen or heard or felt or know somebody who has that prices have gone up. So that takes us to the lag indicators. So I'll start from a national scope. Existing home sales have fallen for the last 6 straight months. So that's not a good trend. We're trending downwards with that. That's followed suit by average sale price. Now, while that's risen, and that's a function of supply and demand, which I just explained, and it's not surprising given the shortage of inventory, it's starting to slow down at the slowest pace that we've seen in the last 2 years. So that's something to keep an eye on. What we're seeing and feeling as real estate professionals in the trenches is we're seeing longer days on market right now over the last couple months, since probably about the midsummer. We're seeing homes that need to be positioned more in line with what's active on the market and not selling versus what is sold in the previous months. So you need to look at the competition and price competitively against that because that's telling you what's selling versus what's sold in May or June or one of the previous months. So just being more proactive with your positioning. Now, why is this happening? So home affordability is the weakest that it's been in the last decade. So you can thank rising interest rates and rising prices. It's made homes less affordable. So you're seeing buyers kind of get standoffish and stand on the sideline, wait on the sidelines until things can kind of steady a little bit. What's next? Home affordability, unfortunately, is not an easy fix. It's a function of interest rates and prices, and those things aren't corrected overnight. So we're not going to slide into an immediate buyer's market. It doesn't happen that quickly. Obviously, 10 years ago, we had a bubble burst. We're not anywhere near anything like that. The conditions, the climate with our industry just isn't set up that way anymore. We're a much safer environment now than we were then. So this pullback will be much more progressive, much slower than immediate as we saw 10 years ago in the recession. Interest rates are expected to rise. I think it's important to note that they're a full percentage point higher than this year than they were this point last year, and they're expected to rise throughout 2019. So that's not going to help home affordability. We're going to also see the market continue to soften. Now, that doesn't mean buyer's market or seller's market. It just means that things are going to be a little more opportunistic. You're going to have to position yourself a little better. For buyers, you're not going to see as much competition, which might be a nice relief because it's been a very fast-paced, quick-moving market. But things are still going to be expensive because of interest rates going up, and prices, like I say, don't come down right away. It takes some time. Sellers, you just need to be more in tune with how you're positioned. You need to look at currently what's active and take a different approach versus, just slapping it on at a price because your neighbor sold, 4 or 5 or 6 months ago at a certain price. So it's just a more comprehensive approach. It's not good or bad. It's just a different opportunity. Beyond that, I think that there's been some signs of showing a possible pullback in the economy, in the market, in the real estate market especially. I know there's been talk of a possible recession. I don't like to throw that out there just as a scare tactic, but housing is certainly flattened. It seemed to have topped off a little bit here over the last few months. You couple that with the yield curve in the bond market inverting, that historically has been a precursor to a recession. So I don't know that we're going to go there. I don't have a crystal ball, but it is something to keep an eye on. And if you're going to be buying or selling a home, it's something to factor in. So I know that's a lot to retain. If you have any questions whatsoever and how that might impact you or somebody you know thinking of getting into the market, please don't hesitate to contact anyone here at Atlas, myself included. We always appreciate your support, appreciate you tuning in, and I'll look forward to checking with you next time. Thanks.